Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Dare Bioscience's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Cerulean was a cancer drug company from 2005 until 2017. Then it merged with Daré. The new entity was named Dare Bioscience and the ticker was changed to DARE. When this merger occurred, the new entity did a 1-for-10 reverse stock split. Cerulean initially IPO'd in 2014 for $7 per share, but it struggled ever since going public. Its kidney cancer drug failed the phase 2 trial, which was the company's second failed trial. The first failed trial occurred before the company went public. Without this merger, Cerulean would have eventually dissolved its entire business. The new entity, the one we're looking at, that focuses on the development of products in women's health, primarily in contraception, fertility, also vaginal and sexual health. The Bill and Melinda Gates Foundation has donated a lot of money to Daré in order for the company to move forward with its R&D. One of its products is a hormone-free contraceptive device called Ovaprene. Drug company Bayer signed an exclusive licensing agreement for this product. If things go as planned, Daré will receive $310 million in milestone payments plus royalties. Its bacterial vaginal product has received FDA approval, the first drug to receive FDA approval from this company. The name of that drug is called Saxiato. The company has a hormone therapy product in phase 2. That's called Daré HRT1. The company's sildenafil cream is also in phase 2. Men use sildenafil for erectile dysfunction. Daré's cream is for FSAD, which stands for Female Sexual Arousal Disorder. It will be the first product to treat FSAD. FSAD can occur in women of any age, but it is more common as women get older and even more prevalent for premenopausal women. The company has several more drugs in phase 1 or in a preclinical stage. The company is headquartered in San Diego, California, and was founded in 2005. The new entity with the ticker DARE started trading in 2017 and can be found on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a microcap company, 152 million market cap. They're trading at $1.99 a share, and they have 77 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So of course they have negative free cash flow since they're pre-revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every year. This is the company's income statement. The top line is the revenue, the sales. That's zero every year. Below that is their operating expenses. These include general and administrative expenses as well as R&D. So of course they have negative operating income and negative net income every single year. This is the company's income statement from their latest 10K. The first 9 months of 2021 versus the first 9 months of 2020. Also the third quarter of 2021 versus the third quarter of 2020. There's no revenue, it's all expenses. Their G&A expense in the third quarter was $2.2 million. That's up from $1.4 million in the prior period last year. Their main expense is research and development. That was $10.4 million. Last year was $6.2 million. Research and development is the process by which a company obtains new knowledge and uses that new knowledge to improve their existing products or come up with new products. This is the main expense with a pharmaceutical company. Within R&D can be the payroll for the employees, also depreciation, amortization, and also the cost of the materials and the supplies to do the R&D. R&D expenses go straight to the income statement. They're not capitalized. They're not carried on the balance sheet. They do pay a little bit in licensing fees to other companies. Their operating expenses went from $7.6 million to $12.7 million, which is almost the same amount as their net loss. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And they don't spend much on CapEx each year. It's mostly R&D. Operating cash flow minus CapEx gives you your free cash flow. So since they have negative free cash flow each year, they're pretty much funding their operations on the sale of common stock. They raised $68 million in the trailing 12 months, $23 million in 2020, $5.2 million, and $10 million. They don't have any debt on their balance sheet. This is the cash flow from operations section from their 10Q, the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with your net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. They had a net loss of $29 million in the first 9 months of 2021. We have to add back $19,000 of depreciation, $1.2 million of stock-based compensation. And this $370,000 gain, this improved our net income, so we have to minus it out here on the cash flow from operations section. Daré received $370,000 from the government. That was from a PPP loan. This was part of the Coronavirus Aid Relief Fund to help companies fund their payroll during COVID. This was originally a loan, but it was forgiven. So the company removed the liability off its balance sheet and passed through a gain onto the income statement. They passed through a $44,000 expense for a contingent liability, so we have to add that back here. A contingent liability is a potential liability that may occur in the future. A common one is if you're being sued and you could put money on the side for a potential settlement in the future. So the reason contingent liabilities are recorded is you want to reflect accurate financials. Because if you're being sued, although you might not know how much you're going to have to pay in the future, you may have an idea. So if you think you're going to get sued for $100 million, you don't want to wait until the day you have to pay it because it will surprise all your investors. You want to post that liability now so it gives investors time to understand things and make a decision if they want to invest in your company or not. There are lots of changes in working capital, but the big one is this $9.6 million in deferred grant funding. Deferred grant funding works the same way as deferred revenue. So if you receive money up front for something, but you haven't delivered the product or service yet, so they take that grant money and carry it on their balance sheet, but they put it in the liability section. They did book all the cash because they did receive all the cash, but they're not going to post the gain onto their income statement until they hit certain milestones. The company talks about it right here. In June 2021, the Bill and Melinda Gates Foundation awarded the company $49 million for their Daré LARC1 drug. The money is used to support technology development and preclinical activities. They did receive $11.45 million in July 2021. Additional payments are contingent when the company hits certain milestones. The company does mention $11.2 million of the grant is in their liability section. So it's carried in the liability section, not the asset section, even though they're receiving cash. Because since they're receiving cash, that increases their assets. And they can't book it as an asset because they already booked an asset. And assets have to equal liabilities plus equity. So they have to book the money as a liability and then pass it on to the income statement as a gain during certain milestones according to this agreement. Like I said earlier, if you're familiar with deferred revenue, this acts the same way as that. Let's look at their investing and financing section. The only thing in their investing section is $15,000 of property and equipment and $14,500 in property and equipment. This is the first 9 months of 2020 versus the first 9 months of 2021. There's lots going on in the financing section since they're pre-revenue, so they need cash to continue running their business. In 2020, they raised $14.5 million from common stock, $1.8 million from common stock warrants, and they received $367,000 from a note. For the first 9 months of 2021, they received $60 million from common stock and $250 million from common stock warrants. Warrants are long-dated options. Normal options generally have an expiration date within 2 years, most of them within 1 year. Sometimes warrants can go 2 years, 3 years, 5 years, 10 years. And warrants can only be issued by the company. If you were to buy a call option or put option, that can be issued by almost anyone and traded in the open market. Only this company can issue common stock warrants for its stock. So if the stock price of Daré goes up to a certain point, the holder of the warrant will convert their warrant to common stock. This is the equity section of their balance sheet. They have $32 million of equity. They raised $133 million from selling their business, and they lost $101 million from running their business. Let's look at the capital structure. They have $32 million of equity and $400,000 of debt. So they're 99% equity, 1% debt. Their net debt is negative $48 million, and I gave them the highest whack on Finbox, 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $890 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company $562 million. We divide that by 77 million shares. And we get a calculated stock price of $7.34. They're trading at $1.99, so they're trading at a 73% discount. It's a really strong buy according to the model. Once Overpreen gets FDA approval, they have a contract with Bayer, and they could receive up to $310 million in milestone payments, plus royalties. So if they get that $310 million by 2024, and the average company in their industry converts 21% of their revenue to free cash flow, so I multiplied this $310 million by 21%. That's how I got to $65 million. Just with this one drug, they're trading at a 73% discount. And they got FDA approval on a drug recently. That's going to add a lot of revenue and cash flow. I'm just showing you, in the most conservative case, how undervalued this stock is. If things go right, you can 50x on this stock. And it's not a super risky situation because they got FDA approval, which is huge. Most companies never get FDA approval for anything, and they did already. Plus, they have lots of drugs in their pipeline. I would have put into the model the revenue from the drug they got FDA approval, but the company didn't provide it. 2 analysts priced this stock, and the average price target was $4. The stock price got really high in the beginning of 2021. And there was a point in July it also got really high. When there's a green candlestick, that means the stock price opened here and closed here. If it's a red candlestick, that means the stock price opened here and closed here. When there's a wick, whether it's on the top or bottom, that means the stock traded at these levels intraday. But the opening to closing price was below this level. You can see all this buying activity. The stock price was driven up when they announced FDA approval. But I'm surprised it didn't go higher. Their beta is 1.34, so the stock moves a little more than 1 times the market. It's gone up 73% in the past 52 weeks, while the S&P is up 29%. The 52-week low was 112, the high is 385. And the stock is trading above its 50-day and 200-day moving average. There's been lots of activity on this stock the past 10 days. Each day averages over 19 million shares traded. Of the 77 million shares outstanding, 75 million are on float, 6.4% are held by institutions, and 2.5% of the shares are shorted. A good sign is that they're adding employees each year. They currently have 20. And the reason the stock price hasn't gone up as much as it should is because it has a low institutional ownership. Institutions are the biggest reason stock prices go up because they buy so many shares at once. They can buy millions and millions of shares in one shot. The general public owns 92% of the company, and institutions only 6%. Vanguard is the biggest shareholder at 3%. Sabrina Johnson is the founder of the company. She owns 1.26%, nearly 1 million shares. Then IPO'd, Lisa Walters, and Polaris. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price of sales since they don't have sales. Their price to book is pretty good at 4.8. That's stock price over book value per share. Their PE ratio and quick ratio are pretty good at 3.1. They have $46 million of cash in their current assets, $2.5 million of prepaid expenses, and in their current liabilities, the bulk of it is this deferred grant funding, which is not really a liability. And they have $3.8 million of accrued expenses and $600,000 of accounts payable. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 17 companies in the same industry as Daré. And Daré doesn't have good ratios since they're pre-revenue. We can't look at the PE or price of sales. Their price to book is much better than average because they have lots of cash from all the capital raises. Their current ratio is fine. Of course, they have a negative ROE since they have no revenue. They are really low in debt, and they're a tiny company, 152 million market cap. So they're trading below cash value because they have more than 152 million of cash on their balance sheet. So to summarize, I have them trading at a 73% discount, but I think it's just a matter of time till the stock blows up. The problem is it could take a year or two because you have to wait for the big institutions to start buying up the stock. Unless you get lots of people on Reddit to start buying it. But they tend to invest in companies that don't have a future. This company has a future. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.